All right, welcome everybody to the fourth quarter economic and global markets update. I'm Chris Rawson and my colleague Brian Bly here. We are going to review a number of charts with you. I think you'll find it informative. And as we get started here, there is a Q&A button on your Zoom. I guess I don't know what to call that, the Zoom bar, the task bar. So if you have questions, please put them in there. As we work through each slide, Brian and I are going to comment on each one and maybe even pause a little bit at the end to even sum up further. So if you have a particular question about a particular slide, please put it in the Q&A. I have two screens here so I can manage these question and answers. We will have a survey at the end to get your feedback. So please take should be less than 30 seconds to give us feedback on this event, because we're going to be hosting it quarterly on the final Wednesday of each new quarter. So of course, we always want to improve. Let me move on and begin with our agenda. And the first piece I wanted to share in terms of the agenda is that October is Cybersecurity Month. And so the call to action that I'll share with folks is that it is absolutely critical, humbly in my opinion, for you to have a password manager. It increases your security online, because the definition of having you not be as exposed to identity theft is having unique usernames and passwords for each website. And as many websites as we have access to, it's not possible, not reasonable to expect to memorize this. And if you have a password manager and you use a password manager, I'm preaching to the choir. And so your call to action would be to tell someone else to start using one, because it really, really helps to fight any concerns that you may have online there. Okay, all right. Now, moving on to our agenda. Each of these bullet points, we have charts to support these details. We're going to review the US economy, we're going to review the global economy, and then we're going to talk about the bond markets as well. And then this is where have we been and where are we now? And then where are we going? So with the economy and inflation, as well as US equities international, and then bond markets from there. And then we have some additional charts that we're going to review as well. So we will cover each of these pieces. Okay, so let's jump in here. Again, if you have a question, please type it into the Q&A, and we'll be sure to go over and cover all the details. So let's start with inflation. Brian, we're all experiencing inflation. This is something we've been coming up on for about a year now. And so this blue chart here, well, let me start in the bottom corner. So here's the 1970s coming all the way up to where we are now. Let me highlight this piece. We have a number of charts from JP Morgan, Fidelity, and First Trust. And so you'll be seeing you'll see the formatting change. On the left-hand side here, we have the percentage change. So you see, inflation rising here, and then we have time on the horizontal. So the 50-year average for inflation has averaged at 4%. We saw the peak in July at 8.5%, and then we're seeing some of this decline in what's called headline. Then with the core inflation, it was at 5.9% in July and saw that further increase in August. The piece that probably, Brian, most of us focus on is food and energy. So we're seeing food prices even continue to rise through August. This is the latest data that we have. However, on the positive side, we're seeing some of these energy prices decline from a 33 roughly percent increase down to roughly 24% increase. So still in these more elevated areas. We'll talk more about inflation. We have several more charts to cover. Brian, anything on this slide that I might have left out?
No, and the main thing is to point out the main difference between headline and core CPI is core CPI excludes the impact of food and energy prices. So headline is incorporating food and energy, and core does not include them. So that's the difference between the blue and the black metrics there.
Okay, excellent. Thank you. Okay, to dive a little bit deeper, and you see this is a chart from First Trust. This middle part, so food, you see this number is consistent, putting in different formatting. All items overall from last May through August have increased by just over 8%. The biggest, now these changed. We had this slide up last quarter. What's now on the top is airfare, natural gas, as you can see, and then gasoline prices. And we've seen a lot in, of course, used car and housing, because these have been quite hot, and they're lower now on the scale. And then this just sort of makes me laugh. It's like televisions have a 20% decrease in price. So, you know, if it's time to upgrade the TV, then you're getting ahead at this point. Anything on this one?
No, and just to make sure, this is not all items of the consumer price index. These are just select items, just to kind of do a broad brush and then dive down a couple items here.
Okay. Okay, unemployment and wages. So the 50-year average for unemployment in this on this gray line, 6.2% average. Wage growth on average at 4%. Here we have the years on the bottom, and then the percentages here. So this is COVID, the beginning of COVID. Unemployment rose to 14.7%. This is when we have, of course, had the global shutdown. Now inflation here, August 22, has declined to 3.7%. So low and really significantly below average unemployment. Wage growth has risen 6.1%. So companies are recognizing that they need to retain their employees, so they're increasing their salaries by more than average, because they really they want to retain their folks. So we're seeing this split here, and this is also driving inflation, because people know that companies want to keep them. Companies know that, of course, prices are higher, and so they're paying to retain their employees so that they can maintain their purchasing power, also so that they can maintain their workforce and whatever product or service that they're offering. Brian, anything else on this chart?
We're good.
Okay. And again, please put your questions in the question and answer box. If there's anything you want to make sure that we go over on our session today, let us know. And then again, anything specific on any specific charts, let us know, because we're monitoring the question and answer tab here. Okay, labor demand. So here again, we have the date on the bottom. And this is the number of job openings to the number of job seekers. So right now in our country, we have 1.87 jobs available compared to the number of people even looking for a job. So there is tremendous opportunity available. Here you see, this is the pandemic here. A lot of people got laid off. These are quits, people just changing their careers or opening their own business. We see that reaction to COVID here. And so there are, people have been changing their jobs. I guess I should flip that. They did not quit, of course, because we all got shut down and retained. And then as we came out of COVID, people started changing jobs and quitting. And then the layoffs here, people got laid off, and then this came down. And so not a lot of people are getting laid off. This is in response to also people opening small businesses. If we overlaid the number of small business applications in this country, they've really skyrocketed, giving people the opportunity to start their own business. So this is further enhancing inflation because we have a labor force that knows they need to get paid more, and they know that they're in demand. Brian, anything else on?
No, really, I mean, this is summarized by the lower right and the left. This is, you can't fire what you can't hire. So, so you don't see that. You see a low point of layoffs compared to the openings, and they just can't, companies are having to do with what they have, and obviously can't afford to lay off folks for the most part.
Okay. So Fidelity has an interesting chart here that we wanted to add. And so this is labor force participation rate, and talking about our country and as our country gets older. So these are the years and the age of our population aging. And what you notice is that in this area, and so after the pandemic, we're seeing an increase in the folks working, but there are a whole subset of people who are basically retired. So from a demographic standpoint, an aging population, lower participation, and slower work age population growth. So there are more people retiring than there are people entering the workforces, essentially, is the other piece. Immigration, we could use some improvement here. This is a bit of a political issue. I don't want to get too into politics, but in terms of removing the politics of it, if we could work on common sense immigration, that would help, because we have a lot of jobs available for people to work in our country so that they can pay taxes and be part of the community. So this is basically, I don't want to read the chart, but basically and you're going to receive also this chart, this entire 32-page deck here. It's going to be in the follow-up piece. So this is Fidelity's version of it, of commenting further on all of the charts that we've reviewed so far. Brian, anything else on this one to cover?
No.
Additionally? Okay. All right. Consumer finances. This is the piece that I want to highlight. And I wonder if should I zoom in here a little bit, come down to this bottom piece. This is excess personal savings resulting in the pandemic. So pandemic stimulus. So the reaction to COVID was to stimulate the economy, I guess, not realizing that we were all staying at home, not spending money. So, going back into the history of the reaction to this, like maybe there was a little too much stimulus. So there was $2 trillion in savings and cash that accumulated on consumers' bank accounts. And since sort of COVID has basically faded, it's probably the best term to use, there's been almost $1 trillion worth of spending. So in short, there's still $1 trillion worth of cash in individuals' bank accounts as a result of the stimulus that was paid during COVID. And so that's why inflation has stuck around, is because even though it's painful every time we go to the grocery store or even dining out, people aren't totally changing their behavior. They're still spending despite the fact that it's painful in the process. And so this is household debt service ratio. And so what we're seeing is that people are actually increasing, despite all the cash, debt is increasing as well. So Brian, you had a comment.
So one of the things that they've, I guess, recent figures are is credit card debt, as shown up on the right, is part of the overall debt servicing. Credit card spending is increasing. One of the things of note too is the savings rates have declined, even compared to pre-COVID levels. One thing, I guess, consumers have gotten used to spending. So one of the things, observations have been made is they're not getting used to slowing down their spending, and they're actually saving less than they did pre-COVID. So that's just something to keep track of. And, of course, inflation will kind of naturally slow down the spending a little bit, but it's noted that people are just, I guess, the pent up demand goods and more so now in services. Folks are still trying to catch up for the time they've spent during the pandemic, holed up at house in their homes.
Yeah. Okay. So shifting gears a little bit to the next part of the presentation here. This is a chart from Fidelity. We like this chart. We review this chart on a regular basis, Brian and I. And so it shares with you the business cycle framework. So early, mid, late in the economic cycle, and then recession. So you see China is here having gone into a recession and working their way out of a recession. The UK and the Eurozone not far behind. Then you have Canada and Korea, and we're here. We're going to talk more about recession. Fidelity is suggesting that we are not in a recession. You see this economic growth positive negative here, where we are just on the line, but there will be a recession at some point. A recession is part of the economic cycle, so it's nothing to be afraid of. It's just part of the process. So it's something for us to navigate and be aware of, but not necessarily afraid of it. We'll talk more about where we are now and how we would plan accordingly for what will be a recession eventually. This chart is sharing the economic activity overall, and the red shows and suggests a recession. So when COVID started, March of 2020, the whole world essentially went straight into a recession because economic activity shut down. And that's why you see all of this red here. And then on the left-hand side, you see the globe. This is developed markets. This is emerging markets for the world. Within developed, you see US, Japan, so on and so forth, and then emerging markets here. And so these are broken down accordingly. So where we are in 2022, you still see a good amount of green. You're starting to see some yellow here in emerging markets. This is China having been in their recession so far this year. And then you see here, August and September. So they're coming out of it. That's where this green is starting to flash there. And then again, you see the consistency between JP Morgan and Fidelity. And so we like to sort of have a mesh of these different companies' data points. And so then you see August here is red for us, but have improved. So we've had sort of fits and starts a little bit this year, but globally, the world is slowing down. We're going to talk more about international as well. Brian, anything else on this chart that I may have left off?
No, we're good.
Okay. And so next piece to highlight is inflation. So Similar breakdown, developed markets, emerging markets. The list is not identical here. You're seeing more emerging market countries being broken out and highlighted anyway in terms of their inflation. And so inflation is reflected in red. So you see a lot of the red starting to come in here this year, July and August. A lot of red continuing. Japan maybe not having as much inflation. And then you see China and Indonesia not having as much inflation there. And then this, Brian and I were talking about this earlier. India here in the high 6s, 7, this is their average already. So they're not meaningfully above average for inflation that they've been experiencing. So that's the discrepancy between why you see a number like 6.7 in here with a color that would seem like it should be red, but it's because that's essentially on trend for them. Brian, and we'll get into global rising interest rates here in a little bit. Brian, anything else on?
No, the main thing is this is really a lot of this is more the trending values as they go from the deep blue to light blue to pink to maroon. That's the trend of increasing inflation versus the opposite of when it goes more towards the blue is decreasing inflation. So as you can see here, most countries, even the ones that are relatively low, they haven't hit peak. Everybody's moved into a higher inflation regime across the world.
Mm-hmm. Okay, so we hadn't mentioned this yet, but this war between Russia and Ukraine, this is also adding to inflation because it's caused a total disruption in a number of different areas. So the gray, bar here is the global production contributed by Russia, and then the gold is the contribution from Ukraine. So another reason we've seen food prices increase is because Ukraine produces a healthy amount of wheat. Fertilizer has to do with the longer term cost of food going down to manage that, and then corn prices here, maize. And so eventually this war will end. We don't know when, of course. And so when that eventually happens, that will ease some of the pressure because Ukraine will be able to go back to being an agricultural producer, which we can see they have is unique for them specifically. Brian, anything else on this chart?
No, in general, of course, this what just depicts in general commodities year to date 2022 are up across the board, whether it's energy related or food related. Now they have decreased across the board in third quarter as countries are adjusting to and looking at alternate level sourcing or usage, cutting back on usage, but overall, all the commodities have increased year to date. But the trend is they're coming down a good bit, at least right now, across the board from both the energy and the food side.
Okay, rising interest rates. Interest rates are rising both in the US and internationally. So you see the US here on at the end of the third quarter, US interest rates for 10-year government bonds at 3.8%, reflecting a rise of 2.6% from March, even higher from the beginning of the year. Germany is raising interest rates. The UK is raising their interest rates. Japan to a lesser degree, and China has not risen interest rates. Of course, as we know in the US, this is not going to stop, not until inflation starts to get tamped down. So the Federal Reserve meets every 10 weeks, meets every 6 weeks, which means they meet 10 times per year. They don't exactly meet every month. And so the next meeting is in the beginning of November, actually right around the election. Then we'll have a December Fed meeting. And so we're expecting interest rates to rise in November, rise again in December, and then even possibly rise again in the beginning of 2023 based on that 6-week cycle. Brian, anything else on this chart?
No.
Now, so rising interest rates has to do with our government debt as well. So as we all know, our country, we run a deficit. We sell our government bonds to fund our government, and then there's a cost to finance. This is the budget deficit here. I mean, it says surplus because this was a unique time, I guess, under Clinton, where there was a surplus. So the response to COVID was a lot of government spending. So we had major stimulus here, and now this year you see this has fallen off, gone back to a more normal place in terms of the budget deficit. One of the things that, and I don't want to get too into politics, but this is going to come up in November and even in the next election cycle, is how we run a deficit. Well, the question is, what does it cost us to run a deficit? And the answer is, it cost us 7%. So net interest is this line right here. It cost us 7% of our budget to run the government. Medicaid and Medicare is 26%, Social Security is 21%. So close to 50% of the government budget between Social Security and Medicare, Medicaid, 13% for defense spending, non-defense at 16, and other at 17. So the cost to finance, to run the government, is quite low. Then to build on that further, which I'm trying to alleviate some of the concerns, because anytime you're listening to the radio or watching the news, they're trying to do that needling effect, drive anxiety. And so the foreign ownership of US treasuries is 36%. So the idea that our country is beholden to the world, whether it be China or Japan or anyone else who buys US treasuries, is a false dialogue. It's simply not true. China owns 14% of our bonds. Japan owns 17% of our bonds. And you can see how this percentage relationship moves on from there.
Yeah, and actually the China percentage is 14% of the 36%. So just that is 36% of foreign ownership, and then the chart to the right is the percentage of that percentage.
Thank you. Thank you. So the idea that we're on this, a doom and gloom trajectory is just not necessarily true. And so I wanted to highlight some of these alternative points that come out of rising interest rates and the fact that we're going into the fall and this election cycle, to give you those, points so that you can minimize some of the stress and anxiety that goes into some of our news media messaging that we receive. Brian, anything else in here? Okay.
No.
Moving back on to the economy and growth. So the economy, our US economy, is driven 2/3 by the consumer. So you see consumption there. Government spending is here, investment minus housing costs, and of course we import from other foreign countries, and that takes away from our growth because of the fact that we're just bringing in more than we're sending out. The trend for GDP growth, domestic production, is 2%. So this is this dotted line here. Here's COVID. Coming out of COVID, we actually got back to the trend line. So we made all the progress back from the shutdown, but we've given a little bit of it back here in the beginning of the year. So this is quarter over quarter. And so we had a negative quarter in the first quarter of this year, slight negative in the second quarter, and we're going to get this data point. I believe it's on Friday. We'll have the updated GDP number, which is expected to be positive. This next slide that we'll go through, we're going to talk more about recession. So let me actually go there and highlight this piece, and then Brian, if I left anything out, then
Yeah, I mean, and the one reason, and one of the things here that we'll be going over is definition of recession differs. Some people have referred to as 2 consecutive negative quarters of GDP. And then what we'll cover here.
Actually, why don't I let you take this one? Go ahead.
No, it's fine. And so this is the NBER is the organization that determines recessions, and oftentimes recessions are marked or claimed in arrears as far as looking backwards in numbers. But as you can see from here, if you can see the print, there's lots of other factors that go in
Make this bigger.
to the determination of recession. One of those, like we talked about before, that's not gone down was non-farm payroll employment. There's other employment figures like the household survey, consumer spending. Once again, those areas are, as we covered earlier, have not trended downwards. And then you've also got wholesale and retail sales, which we'll see how that goes, as well as industrial production. So industrial production, as we saw before, is getting a little cooler. But by all means, just having the effect of inflation and rising rates and all, and the negative GDP they're not the only determinants going into as far as a recession, claiming a recession.
So we did go into recession in the beginning of the pandemic. There was a global shutdown. So that's why you see this red bar here. And so this has been a bit of a debate and different arguments about it, but we do not feel, and neither does Fidelity or JP Morgan and these other companies, that we are not in a recession now. We're in the late cycle of our economic cycle, and so I just wanted to sort of highlight that piece about this. Okay, so as I mentioned earlier, there will be a recession. It's part of the economic cycle. We know it's coming. It's not something to be afraid of. It's just part of the process. And so part of what goes into a recession is decreasing revenue, earnings for businesses. And when you look at this chart down here, this year, the S&P 500, the price of the S&P 500 has declined by about 25%. That was at the end of September, at the end of the third quarter. Well, that's the earnings, however, have not decreased this year. Actually, earnings have increased by 5%. And so multiple growth is another way of saying, well, basically price. So the price is essentially declined by 30%, but because earnings have risen by 5%, we have like a net return of roughly 25% here. So just wanted to highlight that as we move through the economic cycle, these are the areas that Brian and I focus on in terms of the earnings and how companies are dealing with rising interest rates and as the economy slows further. Good.
Yeah, and if you see on the left there, as far as that's the consensus analyst estimates. So that number, is anticipated that it'll probably come down a bit, because a lot of analysts have not changed their estimates moving forward. So, where you see that, I guess relative to year over year, increase there, those bars should be coming down in height. We're right now maybe like a third or so in the way of, as far as the third quarter earnings seasons, for companies.
Mhm.
It's been generally very good so far, but a lot of companies haven't, I guess, projected into, what's their estimate or what's their view outlook for 2023. So some companies have project their outlook. A lot of that will probably not come about until maybe the fourth quarter, when they are basically forced to kind of give their forecast or projections for 2023. So expect that on that left-hand chart, those estimates are probably coming down a bit. Of
Mhm.
course, energy is doing very well. The other industries sectors will probably, be maybe about zero growth to slightly positive, slightly negative, I guess is what folks are projecting out. So
Okay. Oh, I skipped one. Come on, computer. Okay. This is a piece that Fidelity highlights that I definitely appreciate. So it describes the late cycle, which is where we are now. So pace is moderating. Labor job market is tight, meaning there's a lot of jobs available and employees know it. Credit conditions tightening, i.e. rising interest rates. We're checking all the boxes here. Fed is tightening. Corporate profits, growth under pressure. All of these things is exactly what we're seeing now. We are not in a recession because this is not what we're seeing yet. So it seems a little bit dysfunctional in the sense that monetary policy here, Fed eases. So the Federal Reserve is raising interest rates this year and into next year. After the economy slows and we get into a recession eventually, the Fed is going to reduce interest rates. So it's like we're raising interest rates just to reduce them again in the future. So there's a little bit of, can be some cynicism in there, but the truth is the Fed will be lowering interest rates at some point in the future. Corporate profits decline. So again, these are the things that we're monitoring and looking for and anticipating in terms of a recession. Okay. Global supply chain and inflation. So this is back to a JP Morgan chart here. Output, in the input prices drive the output. So if you have higher input prices, things are going to get more expensive on the back end. Here we have prices rising, and then here we have the years. So here's the pandemic, and out of the pandemic, immediately we saw prices rising, and then of course cost of goods rising as well. Well, prices have been coming down, and so here again, output prices have been coming down. You may have heard on the news of companies like Walmart and Target. They actually have too many products, too much supply, and so the promotions, the discounts we're going to start to see them a lot more if you're not seeing them already. Whereas last year around this time, it was like, if you want to get holiday gifts for your family, order them now. That is not happening this year. There is a tremendous supply of goods. So in terms of, people getting a discount for what they're looking for, those promotions are coming. Brian, anything else on?
No, just to kind of a comment on like the delivery times on the left-hand side, like for within the last 2 weeks, there was, I saw something where like, I know chips, semiconductors has been in the news, especially like in relation to autos, like, the chip industry has, started to see lead times start to come down now. So there's signs across the board of, the supply, being readily available, or in some cases, like Chris mentioned, in some cases of some of the goods, being actually increasing to where we're having an oversupply or an over inventory of goods. So all this is contributing, will be contributing to eventually, inflation coming down, continuing to come down over time.
And additionally, all the ships in California, what was miles and miles of ships off the coast of California is gone at this point. The lead time in California is, there's no more, there's not a glut of shipping containers anymore. Okay, this is a Fidelity chart. Inflation to moderate, uncertain about commodity prices. So let me make this a little bit smaller. Okay, back to 2018 through where we are now, and then headline CPI's inflation. So here we see inflation having risen through the summer, coming down, and then what Fidelity is highlighting is here is that if commodities decline at a rate of negative 15%, we're going to see inflation fall faster. If it does not decline, or maybe even some of those costs remain, then we'll see inflation decline at a less speedy rate. What Brian and I wanted to highlight on this chart is the fact that despite energy prices, inflation will be coming down. It's just a matter of to what degree that we'll see overall inflation decline. Okay. Now we're going to get into the weeds a little bit in terms of how we're managing the models and how we're looking at where we're going moving forward. So this is highlighting the difference between value and growth and the impact on operating income of a 1% rise in revenues. So with rising interest rates, the financials tend to do really well here. And last week was earnings for a lot of the banks. So you saw Bank of America making billions of dollars on interest, the difference in the interest that they collect and the interest that they pay out to other people. There was, I think it was Goldman Sachs last week as well, making billions of dollars on interest. So financials are positioned to do well with rising interest rates. And so we have an overweight towards value within our models compared to growth. Of course, we've been talking about energy throughout, but we still do have some exposure to growth because some of these areas will, once we come through the recession, we're going to want to have ownership in that area because long-term growth is going to compete and do well here as well. Brian, anything else to highlight on this one?
No.
Okay. Do you want to take this?
Sure. So this is, we started the last quarter. This is really showing more particularly on the far right is the relative, historically, the price earnings ratio as a percentage of the average 20-year price earnings ratio for the various caps. So we started doing this movement particularly last quarter, and we'll continue to do so this quarter. So as you can see, from a relative perspective, large cap value is positioned better than growth. Last quarter we shifted from growth to value, as well as we shifted to more defensive, larger companies from small to mid cap. Even though you see the relative PE for small being relatively low right now, it's still a little bit early to get into that. And that's something Chris and I will continue monitoring. So a lot of times the small caps will lead coming out of a recession. So it's a little premature to start moving into that area, but as you see us see the US economy moving through cycles, we'll reshift a bit, probably from the large cap down to the mid and the small cap.
Yeah, exactly.
Yeah.
Okay.
And as you can see here on the year-to-date figure, you can see, I mean, grant everything's, unfortunately, the market's been not very kind to us still in the past year, but from a value growth perspective, you see a lot of the value, the defensive traits of the value, especially like in the course of the sectors that Chris has showed, but also more like the dividend payers. That's influencing, continuing to influence how we position our portfolios for you all.
Yeah. Okay. Here again, directionally, where are we going? This is a Fidelity chart showing why we do not own a lot of emerging markets. We own just a little bit of it within the model. And so this is showing global growth and so this is the annualized rate here. And so what you see is there's some established countries like Italy and Spain that are really not expected to grow at all. If anything, actually, they're expected to decline. And so you look in these more growth area emerging market countries, and you see growth of 3+%. This is why we have that small portion in emerging markets, is because they are positioned to grow, and they'll end up having a net benefit to us by owning this in the model itself. Okay. Here again, getting into the weeds of bonds. This is a chart that walks you through how the value of a bond. Let me make this a little bit bigger. With interest rates that rise 1%, whatever the length of your duration. So think of duration like the length of a CD. You can have a 3-year CD, you can have a 5-year CD, which means that you buy the bond or you buy the CD and you commit to owning it for those 3 years. After the end of those 3 years, you get your money back because it's a loan, and you would have collected the interest along the way. The longer the duration, the longer the length of the CD, the more negatively affected that position is to rising interest rates. So this is something that we focus on a lot and maintain. We want to be closer to that fulcrum, closer to the center point. So we do not own long-term government bonds, and we're not experiencing these big significant negative declines because we're aware of this risk. And so we position the bonds to have a short duration, and we have a couple of slides to highlight further getting into. It's a balance. I want to give you all the details, but I also don't want to burden you with all the details. So I'm going to try to keep it concise, but still highlight what we're doing. So this next piece talks more about government bond, or I shouldn't say government, the bond market. And so we are experiencing a rise in interest rates. Well, I just showed you the chart that says when interest rates rise, bond values fall. Not all bond values decline with rising interest rates. So if you look at these gray charts, there are a number of them that do not. So leverage loans here, still positive. ABS stands for asset-backed securities, US high yield, convertibles, and short-term US treasuries here. So naturally, these are the types of bonds that you own in your model because we're experiencing a rise in interest rates. And so, of course, like we said, interest rates will decline eventually. We will change the mix within there. There's no cost to do this. It's just it's a positioning piece. Brian, based on the time, I think I'm gonna sort of save this for another time in terms of the correlation. There's, let me just sort of make a general statement. Correlation means when one piece goes down, the other piece goes up. So you can think of this as like 3D chess a little bit. There is a correlation between bonds and the S&P 500, and there's a correlation between bonds, the bond that you own, and government bonds. So we are aware of these correlations, and this plays a role in the mix of bonds that are in the model as well. Okay. A little bit more in the weeds. This is high yield bonds. The default rate long-term for high yield bonds is around 3.5%. Default meaning that the person who owns the bond can't pay the interest and they default. The default rate lately, or as of the end of the third quarter, is 1.2%. So this is the default rate here, dropping tremendously. Now it's increased a little, but well below the long-term average. So we do own some high yield bonds and feel comfortable with the risk associated with this.
Yeah. And to Chris's point earlier on the high yield bonds, even the ones we own, we tend to own the shorter maturity side. So that further isolates default rate as opposed to somebody that has like a longer term 5, 10 plus years, where there's a lot more time for a company to potentially default on those bonds.
Yeah, within high yield bonds, I mean, we look at these charts every 3 months. And they all flow into the same data set. We refine it, and you can buy a longer duration high yield bond. We just know how to avoid it, essentially. Okay, sort of wrapping up our session here. These are our long-term charts that we're wanting to show you to give you some context on what we've been experiencing so far this year. So this is the S&P 500 daily volatility, number of days with greater than 1% move, whether it's 1% positive, 1% negative. The average is 62. What we have so far this year is 93. So if you're feeling that, I think we're all feeling it, those gyrations, it's because we are, about a third more already, even here being at the end of October, than average. So it's been a volatile year, and we're just beyond 3/4 of the way so far. This chart gives you a comparison, a visual to look at bear markets and look at bull markets being when we're in a growth mode, bear market being when the index closes at least 20% down. So we have experienced a bear market this year. It's been 8.8 months. It feels like a long year. And then here, this was a bear market during COVID. And so what you notice overall is the time that we spend with our accounts growing versus the time that we spend with accounts declining is, well, it's 75% compared to 25%. I'll just go to this next chart, Brian, and then use this as an example. So when you compare over 96 years, close to 100 years, 70% of the time we make money, 30% of the 7 out of 10 years we make money, 3 out of 10 years we lose money. So we'll see positive growth twice as often as we lose money. And as you've probably all heard me say, it's just twice as painful to see the account balances declining versus when they're growing. And on the extremes, when you see something like down 28% or down 21% since 1926, there's 6 between these two. And then when you look at up 21% or up 28%, this is actually the most in this column compared to any other segment. And then seeing a long-term average of 10.5%. So we thought this was a good sort of helpful reminder, despite the fact that we're experiencing pain for the year, of sort of setting the table of what we're experiencing here. Next, this is maybe getting into the weeds a little bit more. This is the S&P 500. This is the Dow Jones Industrial Average. We will see a -5% decline about 3 times in any given year, a 10% decline every, almost year and a half. The numbers are quite similar between the Dow Jones Industrial Average and the S&P 500. -15 every 3 years, roughly every 3 years, -20 every 5.3, 5.75. So what we're experiencing now, we're not expected to have to experience for some time in the future. And this last chart that we always like to share, and you've probably seen before, is the annual returns versus the intra-year decline. So if you only checked your account balance on January 1st and December 31st, this gray bar is all that you would see. And so you would see positive results 32 out of 42 years. And of course, you start to see the formatting. So this is a JP Morgan chart. And so here again, 70% of the time you're seeing positive. And then the intra-year declines are the dips that we experience. So every year, the market goes down at some point. We don't know when, we just know that we're going to lose money at some point every year. Well, and First Trust would say we're going to lose -5% at least 3 times every year. Well, so this is where we are right now. It ended up down 25% at the end of the third quarter, and this was the low point for the year. I won't go too much into the details. I could probably spend another 5 minutes on this chart walking you through this. But essentially, for all the pain that we've been experiencing this year, wanting to highlight for you that it is part of the process, and we're aware of it, and we're monitoring it, but wanting to give you the long-term sort of zoom out picture on how it's going to improve, because of course we do financial planning. So this is a lot about the economic update and asset management and the economy. But what's really important are your goals, your financial goals. And we take all these data points and apply it to your financial plan so that you can have confidence in your long-term goals and results. But we've added this economic update to give you some context and speak to the results you're experiencing in your portfolio, and continue with our ongoing planning sessions separate from it, but give this the time and attention it deserves. So that's of course the purpose for this session. Again, we're going to have the economic update on a quarterly basis on the last Wednesday of each quarter. We have a few minutes left. I mean, we can stay longer for anyone who has a meeting, of course. Thank you for attending. Let me just pause here for a moment. Anyone has any questions, please put them in the question and answer area here. Brian and I can take some more time to answer any questions. Brian, anything I may have left off that would be
No,
something else to share?
not anything else comes to mind.
The only other piece I would like to ask, we do have a poll at the end here. Should take you less than 30 seconds to fill out. Let us know what you thought in terms of your expectations, and then any areas for improvement. So We don't have any questions at this point. Feel free to reach out to myself and Brian directly, any questions that you may have. Having said that, it's 1 o'clock, so I want to respect your time and thank you for attending, and we'll see you next quarter for this webinar. Alrighty, have a good day.
Thank you.
Bye-bye.